Hello and welcome to the first ever episode of the Profitability Podcast, the one where we figure out all the bugs and kinks and try out video conferencing. Today, I am joined by one of our partners. This is Matthew Mooney. He's got an extended background in the trades private equity sector, spent many, many years quarterbacking very large deals for Apex, which for those of you that aren't familiar with it, is probably the largest or one of the largest, if not the largest buyer in the HVAC space. And I think they may have branched out into other trades as well. Mooney went through and evaluated basically the purchasability of companies, what Apex would be paying for them, and how to integrate and scale and realize the goals for the business after acquiring them. So in short, there are very few people with that much more expertise in terms of how to build and scale an HVAC business above a certain scale and how to appraise it. Matthew, does that more or less accurately cover your background? I assume I'm skipping a whole bunch.
Yeah, I think you got the main gist of it. So to kind of get a little bit more into specifics, yeah, as George said, worked on a number of large deals, but also there were relatively smaller deals. So Apex was, very active, and they remain active in the market today, really just across the country, not only in the HVAC space, but also in plumbing and electrical as well. Um, but so specifically, where I really came in for the most part was on the execution of deals. So after the kind of initial terms had been agreed to more with the sourcing part of our M&A team, I would come in and really just make sure that on the diligence side of things, essentially we confirming that we were buying what we thought we were buying. And there were, a number of potential pitfalls that owners could step into, where they were hoping to get, say, $10 million, but then when we really did, lift up the hood and see what's going on, that we'd have to ratchet down the purchase price, or make certain things contingent as opposed to just getting cash up front, because there was a little bit more risk involved than we originally thought when we kind of signed the LOI. So I was involved in the operational stuff, but also kind of being the liaison between the different legal teams, and kind of navigating all that fun stuff as well, kind of crossing the T's and dotting the I's, kind of everything involved with the deal process there.
So those are a lot of details. Let's dig into a few of those things for those of us that don't live and breathe these deals every day. So essentially, like post LOI, you would go through and evaluate essentially like what the main risks were associated with buying that business and whether or not the purchase price was accurate. You want to talk a little bit more, like how did you guys decide on a purchase price for a company and what kinds of things knocked it down?
Sure, absolutely. So the main drivers for the purchase price, the main one is EBITDA, or effectively net income, kind of bottom line earnings. Top line revenue is also probably the number two factor. Those were really the two main things. Other factors were what market was the company in. If you happen to be in a major metro area, there's just more room for growth. So that would help your multiple. If you're in the middle of nowhere, the opportunities are a little bit more limited, kind of limits growth, so kind of can depress what you get bought for. But also other major factors include, is the company currently growing? So, if they're at $1 million now, would have been at $1 million EBITDA for the past 10 years, kind of low growth, that brings down your multiple. But, if you were, 200,000, 500,000, $1 million, that growing company is gonna go for more, because it's obviously showing that, it's trending upwards. That'll help your multiple there.
So if you're an owner considering selling, then you mentioned top line revenue plays in as well as bottom line. So rather obviously, net income higher, good. That much, like we can all wrap our mind around. How does top line play in relative to that?
Sure. So it's a little bit counterintuitive, but if you have more revenue, that does increase the value of the business somewhat, even if you have the same bottom line. Just if you think of it from a buyer's perspective, if I have two companies, say company A is $10 million and $1 million of EBITDA net income, company B is only $5 million and $1 million of EBITDA net income. Obviously, company B, they've got a better margin profile, which is a plus. But the downside from the buyer's perspective is, after buying the business, there's really less opportunity to kind of fix things up, so to speak, and grow the company's income from there.
If you have $10 million of revenue and $1 million of EBITDA, it's going to look better than if you had $5 million of revenue and $1 million of EBITDA, because the margins on that $5 million company are already better and there's less opportunity to improve upon it. So that combined with what you said earlier, it sounds like if I'm a business owner, specifically in one of the trades, and I'm looking to exit for better value, it makes a ton of sense for me to be reinvesting those profits into growth ahead of time to get that top line up. And I'm not going to get dinged quite as badly for having a lower net income margin, so long as I'm growing and that top line is higher. Does that sound about right?
In general, yes, you do also want to be careful. It can be a bit of a double-edged sword. Obviously, there's Apex is not the only sophisticated buyer. A lot of groups that buy specifically just trades businesses, but also a lot of PE groups getting into the space. Although I also want to make sure that that growth is real and sustainable. But assuming it's not you're not wildly overspending on advertisements, and the growth is sustainable and real, so to speak. Yes, you won't get severely punished necessarily for a little bit elevated ad spend as long as the growth is there. That's correct.
So how would you decide whether or not that growth spending is reasonable or wild? Like what variables are you looking at to determine whether or not this is a justifiable, stable growth?
So a lot of it just comes down to internal capacity, or really the people. Just almost working backwards from based on the team I have. My technicians. How many jobs can I be servicing per day? How much is the average job? And just kind of doing a weekly or monthly build from there. And really, that's probably the healthiest way to target how much revenue you can be doing. And then just try to obviously, spend what you need to in order to get those leads. That's really the best way to maximize revenue. Also, keep customers happy, not screw up too many jobs and get a bunch of recalls. Because obviously, once you're to get a recall, you're taking a technician away from a future job, potentially don't have a happy customer, kind of wasting a lot of money, kind of fixing up something you shouldn't do. So I'm really starting with, operational capacity and capability, and then kind of setting your goals from there, and then spending ad dollars accordingly to hit those goals. And the other factor you can bake into that is, how quickly can you hire and train technicians as well. And obviously that's all over the place, company by company.
So that's like there are a large number of variables that you just described there. And if I start thinking about picking them apart, it sounds like, I mean, are there discrete ways that you quantify the risk or aptitude in each of these? So like, are there discrete ways that discrete variables you'd be looking to capture to indicate customer satisfaction, recall rates, like technician pipelines and the ability to replace these people? Like, what are the kinds of metrics that you're looking for? And do you have any like rough ideas, like how you'd be benchmarking them?
Sure. So for specific numbers for, technicians, I mean, it can depend who you're talking to, but I mean, Apex had and other companies have them as well, but they just have general benchmarks for, how much revenue should each technician, be hitting, whether it's on, daily, weekly, or monthly basis there. And, you can kind of use that as the starting point from, hey, based on the number of technicians they have, is the company we're potentially buying actually hitting this? And that could be a potential room, or lever, or room for growth there. In terms of, proper recall rate, I mean, obviously you want it to be low as possible. If you're doing what you're supposed to, it should be close to zero. But a lot of that, if you've got the right operating systems, obviously Service Titan's the most popular one there. If you've got all the information going in there, it's pretty easy to track, who's getting recalled a lot, and if it's one guy who's having to go back and fix his work constantly. That's an area that needs to be addressed there. But I would say in terms of risk from the buyer standpoint, a lot of it comes down to, are a lot of the sales, or is a lot of the work concentrated just in one, two, or three guys. In order to get to really get to scale, the operations really need to be kind of systematized, or standard operating procedures need to be put in place. And essentially, the company's demonstrated that, hey, so there's a lot of turnover in the industry, but if we have one or two guys leave, even if they're top performers, that they can be replaced, because the systems are set up for someone to step in and replace that. So that's really a major pitfall that was pretty common, particularly for companies that weren't of a lot of scale. As that they have a lot of the performance of the company would be heavily driven by one or two sales guys. If one of those guys were to leave post deal, that would really hurt the companies. Really just making sure that everything is processes are set up for anyone to step in and kind of keep performance going, as opposed to just relying on a couple key performers. Is really how the buyer would think about it there.
So I guess if I were to try and distill this down for a smaller operator, I guess two questions. One, like what kind of multiplier ranges would you be looking at different sizes? And like what was the smallest size that you worked with at all? And two, if I was looking to sell my business for the most I possibly could, what 3 to 5 things would you say would be the most important to focus on?
Sure. So to answer the size of the business, I mean the largest deal that Apex has done, it was north of $100 million. I mean those businesses, they're going to be upper teens multiples, pushing 20x. The smallest deal I worked on, it was essentially in acqui-hire, just kind of a tuck in. We had an HVAC presence. We're looking to roll out electrical as far as licensing goes, effectively just buying out, one guy business so the HVAC company could start doing electrical work. That was, for a couple $100,000. So really kind of the full range there. Obviously the most common size were companies doing, between $5 to $10 million. And kind of what you can expect for those businesses, obviously, depending on some of the variables we discussed, such as, growth, what market you're in. Also, HVAC tends to get a little bit higher multiple than particularly electricity or plumbing sometimes. But I mean, if you're in that $5 to $10 million range, you're probably going to range from roughly 6 to 8x. Once you get north of $10 million, you can see multiples pushed 8, 9, pushing double digits, roughly speaking. So obviously, need to demonstrate that what you think is $10 million of revenue and roughly million to $1.5 million that you would need to prove that's real through the diligence process. But if you can be looking at high digits multiple there potentially.
Very cool. And so, like, if I'm looking to push that multiplier up, what would you say? Like, what are the 3 to 5 things you see most frequently that would be easy focus points to improve your exit price for a business owner looking to exit?
So the first one, and kind of where when I was at Apex, we're always kind of holding our breath, is when we're going through the quality of earnings process, essentially verifying that what you think your revenue and your EBITDA is, just confirming that's real. Usually, I was working with a third party accounting firm to kind of do the deep dive on that. And really, so I would say just making sure that you've kind of got your financial house in order is step number one, just to actually know, hey, here's what my real revenue and what my real costs are and what my real earnings are. Because obviously, if in the LOIs, well, it typically states explicitly, we assume revenue is X and earnings are Y. But when the quality of earnings comes back and says, you thought earnings were Y, but it's actually Y less $500,000, that kind of derails the whole process, and you effectively have to start over now that we know what earnings actually are. So really, just kind of knowing where you truly stand and making sure kind of your books are in order is step one to kind of improving your price, because it's quite common where owners, perception and reality, there's a pretty wide gap in that regard there. I would say another area for improvement, there's when I was at Apex, there's a wide range of companies you worked with, and things were all over the place, a number of different issues. But I would probably say that the main one where buyers really hold their breath going through this process, it really just comes down to keeping your people happy, particularly the key performers. As anyone who works in this industry knows, there's a lot of turnover. And buyers, it's not just Apex, any buyer is frankly scared to death that when you make the announcement to the team like, hey, there's new ownership, that guys are going to say, screw this, I'm out. So just kind of making sure that guys are happy, and that there's a level of trust built there, that guys aren't going to leave right away after the deal's done. Because obviously, especially in an industry with skilled labor, if you don't have technicians, you don't really have a company. So just ensuring that those guys are going to be around post deal, and making sure that they're happy. That's really uh, oftentimes kind of concern number one for the buyer post dealer.
So our two main focal areas right now are essentially making sure that the books are actually what they say they are. The accounting's clean and you can defend all the numbers that you're basing the deal off of. And then making sure that we don't have massive staff attrition post acquisition. So making sure the people that are there are going to stay there, aren't going to leave immediately. So when you're talking about this, the first one seems like it's easy enough to audit, pull in somebody who knows books well and confirm that they're actually being kept correctly, and all the variables that you say are important are important. The second one feels a lot more intangible. How do you mitigate or hedge for that risk?
Sure. So a lot of it is just making sure that you're aligned with each individual, particularly the key performers, kind of confirm what they want from the company. Like, are they fine getting their 35, 40 hours of work in, just hit their wage and go fishing in their free time, or are they looking to grow and move up in the companies? The good thing is, if you are looking to exit, usually for ambitious, good technicians, or really just any good employee, the exit provides an opportunity for top performers. They're going to be part of a larger organization. That actually gives them a chance to move up. So that a lot of times, the exiting can give the team additional opportunity that might not be there if it was just continue to be founded around and kind of grown organically there. But it really just kind of understanding any of their other kind of potential hot buttons. I mean, communicating the and I think benefits is a main area, kind of making sure communicating that, or actually confirming with the buyer that they're not going to screw that up. That's been an area that can get messed up and can ruffle some feathers there. Also, kind of compensation structure moving forward as well. When I was at Apex, it was fairly common that pay would be pretty much, or not for every company, but a lot of companies were more or less hourly. At least Apex was, they wanted to shift stuff to more commission-based compensation. So making sure that employees would be okay with that and don't want to skip out, which again kind of favors good performers. People who might not be as ambitious generally might not like that change. But yeah, essentially it comes down to knowing. Obviously, it's a little bit harder for larger companies to know every employee, but obviously the key performers and managers just know essentially their goals and make sure that the exits kind of aligned with that. And obviously, there's a number of different factors that kind of are involved with each individual deal. But if you've got a good feel for your employee base, you can kind of know if your key performers are ultimately going to be aligned with where the buyer's going to go with the business or not. So, yeah, obviously, kind of having a good feel for that can make a potential buyer feel better about what they're going to get post close.
So I guess, like, how did that process manifest itself as part of the due diligence and purchasing process? And like, did you guys ever coach owners on how to communicate the exit to employees or how to talk about it with them? Because it seems like the single most terrifying factor to an owner would be the idea of presenting the concept of an exit to the employees and losing a lot of trust or like making them uncomfortable, and then having that sale fall through. Like, that seems like the worst possible outcome.
Yep, absolutely. And I mean, that frankly was the biggest hot button issue uh, during the closing process. There were most owners understandably just preferred to, hey, we're not gonna we're gonna loop the accountant in because that member of the team is necessary to get diligence done, but outside of that, we're not going to tell anybody. Obviously, that from the buyer standpoint, didn't particularly like that. It was kind of puts the risk on the buyer side of things. So if you've got a great company, you can do that. At least Apex in particular, they tried to encourage owners to break the news, so to speak, beforehand. But like you said, if the deal falls through, and some guys don't like that, that might be some unnecessary risk that owners frankly don't have to take. But if they decide it'll help get the deal done, it's a risk that they can take there. But yeah, so that like you said, that is a big risk with ruffling some feathers with the change in ownership. Frankly, I just recommend from the buyer standpoint that, hey, if you're unsure of how guys are going to take it, you frankly don't have to tell them until the deal's done. At least kind of as a courtesy to whoever's buying the business, at least the way Apex said, there's typically a big announcement day one when the deal was done, and you kind of address the team and kind of assuage any concerns that guys may have about who's coming in. And usually Apex, I mean, the way Apex said, they were good about having, someone from HR there just grabbing, all right, here's kind of, you to put your name, just put your information in for kind of the new payroll, here's benefits and stuff like that. And just make sure that you've got all the main answers to the questions guys are going to ask, answered there.
Interesting. So, like, if I'm understanding that last bit, it seems like there's a pretty reasonable opportunity for, I guess, easing into this or mitigating some of that risk by first, like, starting to align compensation a bit more with with what the outcome's going to be anyways. So, like, setting up a performance-based compensation ahead of time and working with the buyer before you really proceed all that far to make sure that, like, there aren't going to be any radical changes. And then possibly like soliciting employee feedback and buy-in to say like, all right, hypothetically, if ownership were to change, what about working here do you love? What do you want to make sure does not change as part of that process? There's not just an opportunity to get involved in this like before you're even considering an exit. So as soon as you decide that that might be in the future, there's a reasonable way to get employees engaged with this so that when the announcement occurs, they already know that their interests are being respected.
Correct. Yeah. And I mean, it differs, differs owner by owner. I mean, yeah, there's obviously, some owners, they've, owned the business for 20, 30 years and they're looking to get out. Others, they actually founded the company with the intent to sell. I mean, even to the extent, that you can loop either the whole team or some key members of the team kind of in on, hey, ultimately, we want to get to this business. If we can get to the size and get this number, probably going to make an exit. That frankly helps too with kind of getting everyone moving in the same direction, ultimately getting to kind of your goal for what you want to sell the business for, as opposed to if you're just kind of, operating things and, everyone's in the dark, so to speak, on, your potential exit plans. But obviously that differs owner by owner.
Yeah, that makes sense. Yeah, it sounds like essentially risk number one, very hard, crunchy numbers. Make sure the hard, crunchy numbers are hard and crunchy. Risk number two, very soft feelings. Like make sure that all the employees are actually feeling like they're not going to be taken advantage of at the end of it. That kind of makes sense from a balance
Correct.
perspective.
Correct. Yeah, yeah. Just to kind of, kind of put a point on that too is, I mean, when I was at Apex, I mean, the main things that we would always say we're ultimately buying are, it's, one is the brand and the customer base, kind of, George's HVAC or George's Plumbing, been in the community for 20, 30 years. People know that name, trust that name. And, there's really kind of a level of business that, hopefully you can get without having to do much advertising. And then, the PE guys think, hey, we can come in, sprinkle our magic pixie dust, optimize ad spend, throw some more dollars behind it, do some more recruiting. We can really blow this thing up. That's kind of the way they're thinking about it. But obviously you're buying the brand, and that's something that, PE groups, they can't replicate it regardless of, if they're operating out of $1 billion fund. But then also the other key part is the technicians as well, especially in an industry where there's, generally a shortage of skilled labor guys. If they want to leave, they've got a lot of other opportunities to go work at a place right up the street. So yeah, but that brand and those technicians are really kind of the key things that, money can't buy, so to speak. But then also too, getting the cash flow of the business is, obviously a main reason why they're buying it, kind of ensuring that's, real, so to speak, through the deep accounting diligence is part of the process there.
Would you say that that irreplaceable labor piece, why is it that this particular industry set, so the skilled trades, is so appealing to PE? Why is there so much interest in this?
Sure. It's, probably the main headlight thing that you hear the most is that it's, recession resistant, so to speak. I mean, you think if you're out in Phoenix, George, if your HVAC goes out in June or July there, you're going to
It's
get
an
it fixed.
emergency.
It's
Yeah, I think FEMA gets
yeah,
called in actually.
exactly. Yeah, if your water heater goes out, people don't like taking cold showers. They're going to get that thing fixed. So it's all that stuff. Or your electricity goes out, kind of all they kind of go down the list. It's really not a discretionary spending. People, they're obviously, some people are at home even more today too. It's kind of all the technology and work from home stuff as well. So it's even more critical than it was. You could argue in some areas, but just the fact that the demand's always going to be there, even if there's a bit of a slowdown in the economy, people are still be spending for this stuff. So lack of cyclicality, so to speak, is really a main reason why PE guys like it. But then also it's very, very fragmented, not kind of one or two major players. So essentially the large fragmentation, that's just seen as a huge opportunity for consolidators. They can essentially, what they're able to do is, buy up smaller companies at lower multiples. But when they put them all together and the business grows, the larger organization as a whole gets a bigger multiple. Kind of similar, it just the same logic applies for just, single founder owned companies. If you have, if your business is doing $5 million, you're going to sell for, 5, 6, 7x. But if you get to $50 million, that business is going to sell for 17, 18, 19 times. It's just kind of that larger scale where these consolidators, they're able to buy it 5, 6, or even 10x. But then they keep putting these pieces together in the same market, or kind of in different markets, and kind of the broader company as a whole. Now it's worth north of 20x, kind of a huge multiple arbitrage, because there's just so many companies and so many potential acquisition targets.
So that's super interesting to think about from the perspective of the owner and not the buyer. So as these things get bigger, the multiplier gets way higher, especially if you're like 5 times 500K and then you have 10 times, I don't know, a million, or 2 million, 3 million, like that multiplier plus the increased EBITDA, you're cashing out for a much, much larger check. So this brings up the interesting question of like, when would you suggest cashing out as an owner? Like at what point do you start hitting diminishing returns in terms of effort to scale? And maybe the better question here is just like, are there consistent problems as you scale? Like, are there consistent models and like issues that owners face at different sizes? And when does it start getting exceedingly complicated to manage?
Sure. I think that that $5 to $10 million that I mentioned before, that was a pretty common area, kind of rough, kind of somewhere in there. Call it, $7 to $8 million. It just kind of becomes hard for a single owner to really start managing everything. That's when you really need to start. If you want to scale beyond that, that's when you need to make sure you kind of get service manager with a general manager, get kind of running things. If for the most part, founders, they were technicians themselves, and then they started their own company, and they're pretty involved with the day-to-day on different things. It's just kind of hard to get much beyond that, roughly $7, $8 million, with kind of the owner kind of being pretty hands-on with everything, and not really delegating other things to management. So that's kind of a common spot where I've seen owners kind of hitting their head on the ceiling, so to speak. But also too, once you've gotten to that scale, usually you can be pulling in, over $1 million roughly in earnings as well. So you can obviously afford a very good lifestyle. Getting the business to that size, and depending on what people's goals are, that's it's more than enough money for a lot of people. So they're not necessarily motivated to continue scaling, further than that. In terms of when does it when does it make sense to stop, in terms of is there a sweet spot for if you grow X amount more, are you not going to get any benefit on the multiple? That is frankly, I don't know that there's necessarily a good target for that. In theory, it's relatively smooth. As the business gets bigger, you can generally expect the multiple to kind of creep up. There's not necessarily like a hard cutoff. I would say for businesses that are a little bit on the smaller side, if you can cross like the $1 million EBITDA threshold, that seems to be like, if you're close to that, would encourage you to try to push beyond that. That is beneficial for the multiple, and typically to just roughly $1 million. There will be some that just kind of opens up the buyer universe. There'll be more groups that aren't necessarily interested in going under $1 million if they don't have a presence in the area and can't tuck you in. But if you can get a little bit above that, that might open you up to some potential buyers in a new market. But really outside of that, I'd say roughly $1 million. There's not like a hard target I would say makes sense. You need to hit this number and then you can stop, type of thing. So if if you feel like you've got gas left in the tank, so to speak, you can keep it growing, keep it going. But if you're done, you can't take another day of work, and you can retire and what you can sell for, then that works too. So it all depends on what your goals are.
So that makes sense. Sound reasoning. So if I'm understanding correctly, numerically, your multiplier is going to scale reasonably smoothly. So the bigger it is, the better the number, exponentially speaking. But the skill set to scale seems to hit inflection points. And so it sounds like roughly like south of a million up to a million. You said fewer people are interested in buying it. And I'm guessing that's because it's just less stable. It's a much riskier asset to get involved with. A lot of the operations are still not dialed in. And then north of about 7 million in the industry, it sounds like that's when, even if it is run smoothly, a single individual is going to have a hard time managing it. And so there's a pivot in terms of the entire structure. You need to remodel a lot of the business to get much bigger than that. That about
Correct.
right? Okay,
Yeah, that's
cool.
a good way to think about it.
So like if you're looking to exit, or if you're thinking about how to handle your business, it sounds like step one is foot on the gas up until you're making at least $1 million a year in profits. And that's just dialing in ops. So we should probably dig into that in just a minute. And then after you start getting north of 5 or 6 million, the question becomes, how much do you like running a company versus how much do you like doing the HVAC? Because north of that point, you're just going to be running the company, which means if you enjoy the day-to-day stuff that goes into administration and management, you should keep scaling forever. And if you really enjoy the industry and the hands-on touch, the just high-touch relationship with customers, this might be the time to start getting out.
Correct. It's not even even as you're approaching $800,000-$900,000. Yeah, you're not necessarily dealing with customers directly, but more so kind of you can still be pretty involved with paying specific bills and whatnot, and just kind of day to day cash flow operations. But yeah, kind of once you get much beyond that, um, yeah, you kind of have things delegated a little bit more. It gets overwhelming pretty quickly if you're not just working constantly.
No, this I think probably actually gives us a really easy segue then, because we spent a lot of time chatting about your time at Apex and the perspective of buyers on the business. Let's talk a bit more, or let's talk a bit more about what you do now. So, like, you left Apex what 3, 4 years ago now to come join
No, two
Profitability.
2 years, 2 years, yeah.
2 years ago. Okay. And so, like, since making that pivot, what are you doing with owners now versus what you did before?
Sure, yeah, yeah. So um, now you're effectively just kind of working on the other side of the table, so to speak. So I mean, we work with clients who they don't have to necessarily sell, but a lot of them they are working with us as exit preparation. But essentially, we're just helping clients, more or less kind of capture the value for themselves before sale, rather than kind of leaving low hanging fruit, so to speak, unaddressed for a buyer to kind of pick that up, so to speak, after the sale. The kind of going back to the way the buyer will look at it is when they're doing the financial diligence. Even if the what the seller says is correct in terms of revenue and EBITDA, the buyer's going through and saying, hey, this is where they are now, but we know we can improve, A, B, and C pretty quickly post sale. Like their margins, their gross profit margins too low. Like they have wasteful ad spending here. uh, Leverage our supplier relationships to get better equipment pricing. That the seller might be selling off of an existing, like $800,000 EBITDA, but the buyer knows pretty quickly, we're gonna right size the compensation plans with the team, get better equipment pricing, all this stuff, raise the price to market. We're gonna turn this into like a $1.5 million company pretty quickly. So essentially just kind of working with our clients to make sure that they turn the company into $1.5 million company before selling, as opposed to kind of letting the buyer kind of capture all that value.
And is that an accurate indication? Like, what size of businesses are you dealing with right now? Like, what does the client profile spread cover?
Sure. So on the smaller end, about $4 million in revenue, and our biggest client right now is about $20 million top line, actually a little bit above that.
Like, what kind of results are you seeing with them at this point?
Sure. So we've got one client. They're primarily plumbing, also do a little bit of HVAC and remodel. We started working with them in January. Their year to date EBITDA for 2025 surpassed all their 2024 EBITDA around June or July. So they're on pace to close to actually more than double this year if they continue the way they're going. But yeah, their particular issue was they were plumbing and also rolling out HVAC. They were just having issues kind of managing in each segment. We just kind of helped them clean up their data, so they could see, segment by segment, like residential plumbing, commercial plumbing, HVAC remodel, all the different divisions they have, how profitable each one was, kind of identify jobs that they should cut out, really kind of where they should focus, their time and energy. And also, in addition, kind of increasing EBITDA. I mean, part of that was just kind of shifting focus and improving the revenue mix, kind of, really, really kind of de-emphasizing commercial and new construction stuff, and really just kind of driving everything possible towards the service side. Because that's also another factor in multiples that we didn't touch on before, is your revenue mix does play a big part in this. The buyers, the PE world, they very much prefer the residential work, because that tends to be the stuff that's non-cyclical. But if you're doing a lot of new construction stuff, kind of tied to new housing builds, that's cyclical, generally frowned upon. You'll get a much lower multiple on that. And also, even commercial, while it might not necessarily be super cyclical, it's effectively a different business model. What the PE guys like about the residential home service work is technicians show up to a house, job takes one day, they get paid on the spot, as opposed to commercial work, longer dated jobs and payment terms, net 30, net 60, sometimes net 90. So just kind of that cash drag, and really just a total different flow to the work. It's almost like a different industry. So they kind of, if their focus is residential services, they want companies to do residential work. You don't get paid as much for other stuff.
So, would you say de-emphasize commercial entirely? And then, like, I assume at some point there's got to be an inflection point where you have to start introducing commercial, because residential's got to be tricky to scale above a certain level in any given region. So, like, at what point do you start pivoting in?
Correct.
And, like, when do you actually introduce it into the mix, and how much focus should it actually get?
So that kind of all goes back to ultimate goals, like how long do you want to run the business? What do you want to sell for? If you're looking to sell in the relative near term, kind of the next 2 to 3 years or so, it really makes sense, to the extent possible, kind of just really kind of invest in the form of kind of ad spend in additional residential service leads. And to the extent you've got a commercial team, try to get them trained up and just get the leads for them to go on the residential side of things, because the commercial side is just not going to get as high of a multiple as you can on the residential side. If your goal is, in it for the long haul, so to speak, want to build a massive company, then yeah, rolling out a construction arm. I mean, I don't know if there's necessarily a revenue threshold. I would say just kind of the feedback you're getting from whatever you're comfortable with on ad spend. I mean, it's essentially when you start to see growth taper off and you just kind of want to keep that up into the red trend line going. That's kind of when it makes sense to add commercial potentially.
Makes sense. So basically calibrate around region and demand. Ideally, if you're a small HVAC owner, focus in on residential first because you're going to get better cash flow terms and better margins out of it. And then as you expand, if residential tapers off and you've already tried everything, or you're hitting what appears to be the demographic cap for your region, then it's probably time to start trying to spin up a whole new service line around commercial just to extend that runway out. And that seems like it reconciles really well with what Greg from SFP was saying earlier, which is that like there are very few $100 million plus businesses that don't have a significant commercial wing. It's just difficult to scale residential past a certain.
Correct. And yeah, obviously you know, if you're currently a $7 million HVAC company you want to sell in the next few years, yeah, you're not going to get to $100 billion. So, don't bother with commercial. But yeah, if you're saying, hey, I want to build a giant here and I've got a couple decades, then yeah, that's gonna be a component of it.
That makes sense. So if somebody who's considering selling their business, how far in advance would you want to start working with them, and like what would that timeline look like?
Sure. So if you're looking to sell, we'd want to start working with them, ideally 2 to 3 years before they wanted to sell. Bare minimum, probably about 2 years. Just want to make sure that the records are clean. Kind of discussed that before, but also this stuff kind of takes time to implement too. Time to implement, but also need to see the results on the back end and kind of slowly kind of get those earnings into the company's EBITDA that you're going to sell off of. So, and just kind of why we need a longer lead time is obviously, the buyer's going to obviously look not just at the most recent year, but previous years as well. So obviously the trailing 12-month EBITDA is the most important number, but if there's really a significant jump kind of in the past 12 months compared to the company's past, you'll get a little extra scrutiny. And typically those are the quality of earnings that we see that don't go too well. Kind of sellers try to, push too much bad stuff out of the trailing 12-month period that kind of gets pushed back in diligence, but kind of
Let's
just showing a level of
let's pause for just a minute. You want to explain the trailing 12-month period and its significance to
Sure.
people, just in case they're not familiar with it?
Sure. Yeah. So the trailing 12-month EBITDA, or the trailing 12-month period is usually what companies are sold off of. So essentially, if you're selling around year end, typically just go off of the previous year. But if you kind of midway through or a good part into the year, they'll go off of what's called the trailing 12-month EBITDA. It's just your most recent 12 months, revenue and EBITDA, just to kind of get the most up to date look at the business, as of this moment in time. These past 12 months, we did $800,000 in EBITDA and $6 million of revenue. And really, that's for the most part, that's what buyers will use in place a multiple on. So when you're really getting down to it and kind of close to the sale, if you've had a bad month, for whatever reason, unseasonably cool weather or something like that, a lot of times it makes sense to kind of let that bad month, so to speak, roll off of your 12-month period, and kind of get a better one on to replace it, and then that kind of maximizes your 12-month
Oof,
12-month EBITDA there.
that sounds painful. So if I'm looking to sell in like October and suddenly it's a chilly July, it's like, well, let's check next July maybe. Like, does that mean that we have to basically restart the clock ideally?
So if you've got enough solid operating history that you can point to and say, hey, this was an anomaly, then you might not have to. But for the most part, a lot of the people we're dealing with don't have that. Unfortunately, yeah. If you don't have meticulous records kept, which why we like working with clients at least a few years out, because yeah, if you happen to have kind of one-off month, but we've got everything in order that can show, hey, this is an anomaly. Here's the data to show that. But if it's just you and your word, you're obviously not going to get credit for that. Yeah, it can get a little tricky in terms of optimizing when to sell, and which is why I really need to be on top of things leading up to sale, not just a month or two before. 2 years, 18 months leading up to it, because that's ultimately what you're selling off of.
So that places things in really nice context here. So hypothetically, if everything's already more or less perfect, your operations are smooth and you have data for everything, then there's not a whole lot you'd need to work and need to do in terms of prep. And you could probably weather a couple of bad months during your sale process and be fine. But realistically, like pulling us in a couple of years ahead of time means you have that data and gives you a buffer if something goes wrong during that 12-month period as well. So the more data that you've got to work with, the more flexible, the easier it is to justify your price point, the fewer things that could possibly mess up your sale. Am I right?
Yeah, that's correct. Yeah, it's I mean,
Okay.
just kind of thinking of it from it, conceptually, it's like it's like if you just have the records and can prove that this is a consistently good company, you can get a little grace or forgiveness if you get an unseasonably cool month. But yeah, if you can't confirm that you're a really solid, rock solid company going in the past, and they're not going to take your word on it. So
And that's probably super helpful for context. So I feel like a lot of people that I want to talk to about this sort of thing, everyone's looking for heuristics. So like, what multiplier is my business going to go for? What am I looking like? How do I fix this? What are the steps? And like, we've gone through a bunch of heuristics that you can rely upon. When it comes right down to it, the sales process does kind of boil down to common sense. The buyer is looking to be able to prove that the business can do a certain amount of revenue. And the more data you have to be able to iron in that this is exactly how much it's going to do, and this is how much you're going to earn off of it, and we can prove that you're going to earn this much, and we have a track record to say, like, this July was cold, but it doesn't really matter unless July's on average get colder, because here's the last 2 years we can prove that this is exactly what caused that. So when it comes right down to it, like, there's no way to completely hack it. There are a lot of things you can do to improve it, but realistically, you just need to have data and smooth operations. Like, they're valuing you on things that are actually going to matter. Have I cut out a
yeah,
bit there?
yeah, correct, correct. I mean, yeah, a little bit, but what's also helpful when kind of working with us is obviously we'll make sure that we're fully aligned with the number you want to get, or kind of what exactly your goal is for an exit. So to the extent that you have a bad month to kind of fall off the pace, so to speak, we'll let you know kind of exactly how much you need to make up for that, so to speak. And kind of, all right, missed revenue by a few $100,000 and EBITDA's off by 50 grand or so to speak. We need to just do that much better in August if July was bad. Just kind of know where you need to get back to, as well, as opposed to just like, all right, we had a bad month. Now what does this mean? I'm not really know what to do with it, so to speak.
Makes sense. So I guess like this is probably a very tricky thing to quantify, and we're also going to be running a little short on time soon, so I'll try and keep this one brief. Is there any way that you could ballpark on like an average business within the size range that we're talking about, so somewhere between 4 and 20 million, give or take? What level of impact is it likely to have on the multiplier between essentially like before and after working with profitability, or like before and after the cleanness of books and the level of organization? Roughly, what's the range of improvement you'd expect to see?
Sure. So I would say that, I mean, the main thing we're trying to improve, and we have multiple case studies where we've done that, just the EBITDA itself, as opposed to specifically with the multiple. Yeah, that the multiple itself, it is hard to quantify unless they've gone through a process and go through it again afterwards. You can't say exactly, well, you went from 6.7 to 7.8x multiple. Yeah, I would say just kind of the better data by itself is probably worth half a turn to a turn. But I mean, really, we're just the main goal is improve the EBITDA. That's the concrete improvement. But as the EBITDA goes up, so does the multiple. So does the multiple too. So, yeah, I would say kind of the data itself is good, but ultimately the data we provided is just to impress a seller. It's to help the owner manage the business better. So when we work with clients, we're obviously, if the goal is to sell, we're trying to optimize the business for sale. The vast majority of what we're doing is just helping the business run as good as it can, because that's ultimately what you need to do to get to a good exit, and what you need to make sure you don't lose sight of through the whole process, particularly in the sale process, because we've seen it multiple times where you're getting all these diligent owners are getting these or sellers are getting these diligence requests. That the process can take 2 to 3 months. And then over those 2 to 3 months, they kind of see revenue kind of fall off a cliff. And then the buyer's going to be like, well, now I'm not going to pay you as much because your trailing 12-month EBITDA isn't as good. That's, with all this M&A stuff, that still is the number one important thing, is keep the business running well. You keep the business running well, make sure you can prove it. And then a lot of this other stuff can kind of take care of itself.
There you go, folks in the audience. You heard it here first. In order to have a good exit, run a good business.
Groundbreaking.
I know, right? We're really just breaking out the secret sauce here. But actually, I mean, that brings up a fun one. So, like, how often do you have people that want to sell and we start working with them and they just, by the time they're done, they have a business that's worth twice as much, printing twice as much, and they just change their mind and don't want to sell anymore?
So the client I mentioned before, he has brought up, he's like, yeah, I don't know if I want to sell now, but I still think he's probably gonna go to exit. I mean, I don't know. I think his wife might want him to work less too. So that's always a factor in all this as well. But yeah, to your point, yeah, what we want to help our clients build is better businesses. Yeah, and if you also get optionality once you have a better business, is you don't have to sell. You can just have more cash flow you're putting in your pocket year after year. And if you want to hand it down the next generation, potentially, kind of whoever would come next would be hopefully, better set up to kind of keep the business running well into the future. But yeah, we're, not, we're not strictly working with clients that are looking to sell. If you just really just looking to improve the business, and, things aren't where they're supposed to be, we help the business get there.
Makes sense. And so, like, I guess from your perspective, does it make a difference if they're looking to sell or not from like an incentive compensation? I guess. And then the secondary question related to that: as a fractional CFO, how do you decide a business is a good client or a good candidate to work with or not? Like, what are you looking for in a potential client? Because like, you can only take on a fairly
Sure.
limited number of these things.
Sure. So it just comes down to kind of the number one thing is the goal of the owners. I mean, we've talked a lot about, exit prep and sale potential. The reason for that being is, um, because a business is sold off of a multiple, optimizing earnings right before a sale. Like, you obviously put the extra dollars in your pocket that you're making more at the time, but then obviously you multiply that by 7, 8, 9x, or whatever the multiple is. Probably the most potential kind of cash wise, is right before a sale. But I mean, even if you don't want to sell, we just love working with owners where, I mean, one, there's, noticeable areas for improvement in the business, and the owners, dedicated to addressing those and improving them. I mean, if have a business where there could be potential areas for improvement, but I mean, you don't want to work a whole lot, just want to kind of pop in the office 10 hours a week and, not spend a whole lot with the business, spend a whole lot of time with the business, and don't want to, put a substantial amount of work in it. But I mean, it's your company, that's fine. But obviously, if you're kind of running a lifestyle business, so to speak, I'm not going to be a good fit for us. But if, you're really essentially just, if we can identify areas where, we know that you're not kind of up to standard, so to speak, on where things should be for the market, and you're willing to put in the work to, make the change to get the business there, we'd love to work with you.
So if I have to summarize this, it's essentially have goals. So we basically are looking for either scale or sell. If you have something you actually want to accomplish with your business and you're doing at least 2 or 3 million in revenue from the sounds of it, we are probably a very good fit in terms of formalizing and structuring it that way. Does that sound more or less correct?
Yeah, I'd probably 4 or 5 million.
Okay.
Where we typically have to come in price wise. I mean, a little bit smaller than that. Um, Generally can be handled pretty well in house, but yeah, need a little bit of scale typically for it to make sense with us.
Makes sense. All right. Well, I think we're coming pretty much up on time here. I don't want to run too much over an hour. Any last thoughts, any summaries, anything else you want to leave people with before we call it?
I think we hit on all the main areas. If we didn't,
Chaotically,
we
but I
can
think
we
we
can
got
do it.
there.
We can do another one of these. Yeah. Duh. I
If you're
think I'm
willing to
good for
talk to me
now.
twice, all right then.
If you'll have me back, if you'll have me back.
Well, Matt, thanks for breaking this all down for us. For anybody listening that's interested in working with Matthew or just getting his opinion on your business, profitabilitypartners.io. You can find him there. He works with all of our trade-based clients. And as we've just hopefully proven fairly conclusively, he's got a very robust background in how they ought to run and how to get them where you want them to be. For audience folks listening at home, anybody that you would like us to talk to, anything that you would like us to dig into in more detail. I know we covered a ton of different areas here, and this was just related to HVAC and trades. Just shoot us an email, contact however you feel like it, and let us know. Put in requests, and we will find someone to talk to about it or an expert to go into it. Other than that, I'll come up with a better signing off routine later. Thanks for joining us. Thanks, Matthew.
Thanks, George.